Guys, Intel and AMD, we're going to look at both these companies. This is not a versus, not a should you buy Intel, should you buy AMD. It's just looking at two companies that are within an industry. One has amazing growth potential and one's considered the dinosaur. Now, if you're new to our channel and you like this video, I ask for one thing: subscribe to the channel. You don't need to do it yet, although if you want to, please do. But throughout this video, subscribe to the channel. I guarantee that as you subscribe and watch more videos, you'll have a better understanding of money and investing. Because Mo and I do, what, 2 or 3 videos a day, Mo?
2 or 3 videos a day.
And it doesn't involve just value investing, so please subscribe. So let's take a look at Intel and AMD. Let's first start with Intel. Now, Intel's gone through a lot of problems lately. They just got a $20 billion factory underway down in Columbus.
Yeah.
Big numbers. They're going to be the biggest chip manufacturer in the US, obviously.
From my understanding, it's pretty awesome.
Yeah, we have a friend of ours who's doing work down there. His company has been hired for some of the jobs. Intel has taken a big hit in the last year. They had a 52-week high of $56. Now, here's the thing I want to show you about Intel. Look at our max chart on Intel. Guys, this is 2000. You'd be hard-pressed to find people in 2000 who said Intel was not the company of the future. And look what's happened since. It has gone nowhere. Hit a peak around about 75.81 was the high on August 27th, 2000. Isn't this a new addition to our software, Mo?
Yeah, it is.
I requested this from Tim,
awesome.
And he got it implemented very quickly. It just gives you the all-time high and the date.
I love it.
So that way you can compare it. And I look at this saying,
When you look at Intel, I mean, I hear Intel, there's probably 3 or 4 big companies in this space. Intel, AMD, NVIDIA, call whatever, Micron maybe.
Yeah.
If you would have told me that Intel was at $75, $76 in 2000, I would say that's probably, I don't know, $800 a share now.
Exactly.
Or it got up there and came back down. Hasn't touched a 2000 level.
And Mo, the best part is, people would say, well, the company has died. Okay, let's see what it did in 2000. In 2000,
if this is a dead company, I like dead companies.
In 2000, the company did $33 billion in revenue, and well, there was a fluke year, but call it $10 billion in profit. They had a one-time gain, special income, so call it $7 billion in profit. Last year, they did $70 billion in revenue and $13 billion in profit. So double the profit, double the revenue, and the stock is down 65%.
Yep.
This is the point we're trying to make as a channel.
There's the disconnect.
It doesn't, if the growth is there, but you overpay, you will lose. That's the key here. You can overpay for growth. If that alone makes sense to you, subscribe to the channel. If it's possible that you think that you can overpay for a good thing, then subscribe to the channel. You're going to learn a lot of stuff here. If that doesn't make sense to you, I don't know what to tell you because it's an absolute fact. All right. So let's go check out the 8 pillars for Intel. Now, keep in mind, they spent a lot of their CapEx. Their CapEx has really increased. So we have a couple of check marks here. I love this. Shares outstanding. I think they got to be spending money buying back shares.
Yeah.
This company is selling for single-digit PE, single-digit 5-year PE. And do they have headwinds? Absolutely. For sure. But that's what it takes for companies of this size to be selling so cheap. The story has to be negative. Right, Mo?
Yeah, absolutely. And that's what is getting us to $28 a share right now.
$28 a share,
so
incredible.
Upset about this. I think it was almost at 60 in COVID.
Yeah, it was over 60. I think it was 60. I think it was 60 some. Let's look at that right here. Let's look at the 5-year chart. It had a high of 66, 68.
Oh wow, 67 here.
68 in April of 2021. So just a year and a half ago, it was $67. Wow. Mo and I have been buying, full disclosure, in the 40s. Mid to high 40s we started. We've dollar cost average down, so our position's down, but I'm okay with that. I still believe in Intel, but it doesn't mean you should go invest in Intel because I believe in it.
Nope, not at all.
Do
your own research.
Do your own research. We make different decisions for different reasons. I'm okay waiting 4 or 5 years. Intel is a long-term play. Let's look at analyst estimates for Intel. Okay, so they have 221 EPS estimate this year and 371 in 4 or 5 years. All right, so growth there, pretty solid, low double-digit growth. Revenue, okay, it's going to struggle, but looking at even. Now, keep in mind, guys, the chip industry is expecting 12% compound annual growth worldwide over the next 10 years. If you don't think Intel is going to get a piece of that, I think that's crazy. I think they're the leading chip manufacturer. AMD's chomping at the bit. I get that, and AMD makes a great chip.
They have been for 2 decades.
But they have been for 2 decades. So let's go look at our stock analyzer tool.
I'm curious to look at this dividend too.
Oh, yeah, the dividend.
5.9 billion, 5-year free cash flow average, 10.69 billion.
Now, keep in mind, last year's average free cash flow, Mo, was a crowd-pleasing negative 13 billion. They had a huge capital expenditure year. Huge. Yeah. So that's the thing. That's what's driving down the free cash flow is this big capital expenditure. That's a temporary thing. Yep. Now, the dividend yield, I think the dividend yield is going to be cut.
think it should be. I understand why they don't want to do it. The stock has just been punished price-wise, and people are a cut to dividend. If you cut that in half, it's going to get punished even more.
Yeah, people are going to hate it,
Yep.
right? So it's something to consider here. Now, stock analyzer tool. All right, Mo, give me your revenue growth assumptions.
Okay, let's do -1.
Huh?
What are analysts saying for 10 years?
Well, for 5 years, they're saying low
5
single
years.
digit, basically breaking even.
-101.
So I think -1, 1, and 3.
Okay.
And the reason being is, inflation's there. You also have that compound annual growth rate of 12% for the chip industry.
Okay.
I have to
Good
think
point,
Intel's
good
going.
point.
I think so.
I was looking at the 3 saying, man, I might be a little too aggressive with that.
Maybe.
Okay.
All right. So profit margin.
All right. 19, 21, and 23.
I like it. How about for free cash flow?
Same thing for free cash flow.
Now, I agree
Even
with
though
you, Mo.
It's different, but
Yes, but their free cash flow has been pummeled by their capital expenditures.
Exactly.
So
I think it'll even out.
I agree with you. I'm a big believer in that too, because if you look at their numbers before these recent years, they were pretty close. Now PE, Mosafine.
11, 13, and 15.
I don't agree with 11.
Okay. I do think 11's too low, but I think 16 would be too high.
I think 9, 12, and
Wow.
I think 9, 11, and 13.
Wow. Okay.
And the reason being is, if it's not growing, Mo, if it's a negative growth, you have to get your earnings, you have to get your money back somehow. That's going to be paying a low multiple of earnings and free cash flow.
Yep, good point.
And they get 3%. That's not exactly exciting, but okay, I'll give them 13. I'll give them below the market historical of 15 or 16, right?
Yeah, good
All right,
point.
now desired return. Now, guys, for desired return, I love explaining this. This is your margin of safety, essentially. The larger your assumptions, the higher return you need, because the higher return, the less price you pay. And that's your increased margin of safety. And you can get 9 or 10% by investing in an ETF. So to buy an individual stock, you get a higher return than that. So Mo, tell me.
I'd probably just go 12, 13, 14.
Okay, I'm fine with that. Let's do this. 12, 13 and a half, 15. How about that?
Okay. That's cool.
Analyze button. $28 a share.
There you go.
Okay. Low side, 25, high side, 39, mid price, 31. Now, this high price is lower than our assumption in the past.
Yeah.
So that's why I'm glad we had margin of safety in there, because we might end up being wrong and go, okay, but still, if I'm in the 40s and the 15% return is 39, I'm going to do okay. I'm still going to make my 12 or 13%. That is the point of margin of safety. That even though the thesis has changed, we had enough margin in there to go, hey, we were wrong, but we're not off by much. And that's the key here.
Yep.
All right, so let's go check out AMD. And remember, guys, if you've liked this so far, you got to subscribe to the channel. It takes half a second.
Let's start out with that max chart on AMD.
Yeah, I love the max chart on AMD. All right, so in 2000, AMD was at $44 a share. In 2007, it hit 40. And it didn't hit 40 again until
Oh my.
2019. Yeah, something like that. I'm here at 2019. Yes. So over a 20-year period, it still struggled to beat its high. Now, since then,
for a company that was supposed to be the leader and take out Intel and this and that.
multiple times in the last 20 years.
Yep.
Now look at this. All-time high, 165. 52-week low, 55. What's it currently at, Mo?
Currently at 62.27.
So it's already fallen. So to me, if this company has such a great future, why is it down 60%? 70, whatever the number ends up being. I think it's 60% is the number. That's the point, guys. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What that means is popularity on the good and bad affect the short run. If it's not popular, the stock's going to get beaten up. If it is popular, it's going to go sky high. But in the long run, what matters are the fundamentals. What's the revenue? What's the profit? What's the free cash flow? And most importantly, what price to pay for a reasonable return on that money? That's the key here.
I don't remember what we did last video, so I'm excited to see this. I just opened this up and my jaw actually dropped. Look at that revenue growth.
Yeah.
I mean, 6.4, 6, 8.65, 14.85, and 22.83. That's not sustainable. I mean,
it's going to be hard.
it's going to be hard.
So let's see what analyst estimates are saying.
Okay.
I mean, big profit growth. They're going to expect it to do $3.64 a share this year and $7 in 2026.
Okay.
42 to 17 analysts reporting, and revenue growth assumptions way better than Intel. Yeah, they're at the high single, low double-digit revenue growth for 5 years. So let's do our stock analysis. Let's look at the 8 pillars. I didn't look at 8 pillars yet. Oh boy. Really high PE and price of free cash flow.
Shares.
Increased share of outstanding. But guys, this is diluting people. So even if the company in the last 5 years has gotten 70% better, because if you use 70% more shares, you've gotten no benefit on a per share basis.
It's not from acquisitions because there have been none.
So look at that. That's the key here, guys. Just remember this. Shares outstanding, increasing, diluting you as an owner. Even if the company crushes it, it doesn't give you as much benefit. Again, I repeat, they've increased their shares by 70%, which means that the company grew by 70%. You got zero benefit because it was offset by the number of shares given out there. That alone should be a reason you subscribe to this channel because I explained that to you. Free cash flow, this doesn't bother me, the debt level, because they're still a growing company, so I'm not as bothered by that. But low return on invested capital, that sucks. What was their free cash flow last 5 years? Okay, 1.25 with 2.5 billion. All right, profit margin lower than Intel, but I'll probably get better as they get. Okay, so there are pluses to this, of course, and there are minuses to this, but if you can pay a reasonable price for the growth, let's go to Stock Analyzer tool. All right, Mo Hussein, give it to me.
All right. 10-year analysis here.
Yep.
Let's do 6.
I love it.
9.
Yep.
And 12.
Oh my God, I was thinking the exact same numbers. Profit margin.
All right. Let's see here. 5.
Oof, why 5?
Well, I'm looking at their 10-year.
Yeah, but look at their 10-year. But this is where I disagree. But look at their 10-year of numbers. Like they were a much smaller company. They were going through lots of issues. They didn't have the market share. They had high overhead costs. I ignore this number completely.
Okay, so what
These
would you
two,
put?
I would do 13.
Whoa.
Yeah, I would do 13, 17, and 21 because I think it's going to be pretty equal to Intel at some point.
Wow. Okay.
So let's go lower. Let's go with 10, 15, and 20. How about that?
Sure.
Okay. How about free cash flow?
Let's put the same numbers.
Okay.
PE now.
Yeah. So guys, the PE is currently 44 and the price of free cash flow is currently 39. Remember, this is asking for the PE at the end of 10 years. This is not going to be a massively growing business at the end of 10 years. It'll still have growth potential, but the historical average is 15 or 16 for PE. So Mo, tell me.
14, 16, and 18?
I like it.
Okay. Same for price to free cash flow.
Yep.
Desired annual return. Should we do the same we did? 12?
No, I actually think higher. Higher on the high side.
Okay.
Because I still think that AMD is still the young blood, and it's still. I mean, they've had their issues in the past where they're like, "Hey, Intel, you're done," and then blah. So I want a higher return for these bigger, especially with Mo. Look at these. I went and skyrocketed their profit margin and free cash flow margin.
What do you think on the high side? Like 20%?
I think so. To me, I'm thinking to myself 12, 16, and 20.
Okay.
Hit the analyze button. The stock is currently at $62 a share. It's overpriced. 21, 45, and 33 in the middle. So guys, this is just still telling me be more conservative. Now, let's go change these assumptions to 12, 14, and 16%.
Okay.
It's still expensive. It's still 21, 38, and 58. You still have to be patient. Full disclosure, I have puts on AMD written below $48 a share.
I might too. Don't quote me on that.
Yeah. So anyways, guys, again, if you like this video, subscribe to the channel. We do 2 or 3 videos a day. You will walk away much smarter about money and investing just by watching 4 or 5 of our videos. Thank you for your time.